Welcome to the Deep Dive. We're your essential briefing, helping you cut through the noise. Today, we're digging into a name that's really shaking things up in value retail. Ollie's Bargain Outlet Holding Inc., ticker OLI. Our mission here is to unpack their Q2 fiscal 25 results, get into management strategy, and, break down that updated full-year outlook. This is a retailer built on deals and their latest numbers. Pretty impressive. Let's jump in.
Yeah, it was definitely a strong quarter, really beat expectations pretty much everywhere you look. But I think what's really interesting is digging into why the numbers look so good and what that tells us about, the consumer right now.
Absolutely. So let's start with those headline numbers, because Ollie's didn't just meet expectations. They blew past them. Both GAAP and non-GAAP adjusted EPS landed at $0.99. That's an 8-cent beat. Pretty solid, 8.8% upside versus the consensus. To me, that says their value proposition is really hitting home, even with consumers maybe being a bit more cautious. It feels like more than just a one-off good quarter.
That's a great point. And it wasn't just on the bottom line, right? The top line was strong, too. Revenue hit $679.6 million. That's $17 million over consensus, a really robust 17.5% jump year over year. That signals some really strong underlying demand, I think. Not just padding from new stores, but existing ones, too.
Exactly. And speaking of existing stores, comparable store sales, that key metric, up an impressive 5.0%. But here's where it gets particularly interesting for me. The margins. Big expansion there. Gross margin jumped 200 basis points. That's 2 full percentage points year over year, landing at 39.9%. And operating margin also climbed, up 80 basis points to 11.3%. Adjusted EBITDA, $93.8 million, 13.8% margin, up 90 basis points. What's this margin story telling you about their buying power right now?
Well, those margin figures, they don't just happen, right? They really speak to operational discipline and, like you said, really smart buying. That's Ollie's whole game. And beyond the financials, they were busy opening stores, too. Added 29 net new ones in Q2. That brings the total up to 613 stores, which is, almost 17% growth year over year? That's a huge growth driver.
It really is.
Yeah.
And their loyalty program, the Ollie's Army, keeps growing. Now, 16.1 million members strong, up over 10% year over year. That's a massive base of engaged shoppers.
Yeah.
Now, here's the interesting bit. Despite all these great numbers, the stock reaction was a little muted. It popped down over 6% pre-market, but then it settled back down to just a 0.6% gain by the close. Volume was way up, though. So the question is Ollie's just executing really well, or is the market maybe missing something or seeing some challenges we haven't talked about yet?
You see that pattern sometimes, right? The pop and then some profit taking, especially after a beat and raise. It suggests maybe some short-term traders locking in gains. But yeah, it does make you wonder if the market's fully appreciating the longer-term picture here. My gut says maybe not entirely.
Okay, so let's peel back those layers then. Starting with store expansion. They're aggressive. Management reaffirmed that double-digit annual unit growth commitment. And they're definitely walking the talk. 54 new stores just in the first half of this fiscal year. That's more than 4 times last year's pace in the same period. They actually blew past their old full-year record for new stores in just 6 months.
And they bumped up the full-year target now, too, right, to around 85 new stores for FY25. A lot of the speed comes from opportunistically grabbing good real estate deals. They specifically mention former Big Lots locations. Now, this does mean incurring what they call dark rent, which was about $2.3 million in Q2, maybe $5 million for the full year.
Right, dark rent. For listeners, that's basically paying rent on a building before it's actually open and making money. Why take on that cost?
It's a strategic calculation. Management sees it as buying their way into lower long-term rents and just better store economics down the road, better four-wall economics. Take a small hit now for a bigger win later, basically. And they say these new stores are already performing ahead of expectations. Better planning, soft openings, and what they call a warm box dynamic.
Warm box, meaning they're taking over spaces that already were retail, so it's faster and cheaper to convert, makes sense for speed. And to handle all this growth, they're expanding their distribution centers too. Texas and Illinois getting bigger within 18 months, adding 200,000 square feet each. That gives them capacity for another 100 stores, pushing total capacity toward the mid-800s. And they're already thinking about a 5th DC maybe 3 or 4 years out. That's serious infrastructure investment. You need that to scale properly.
It really shows they're thinking long term. And here's a fascinating little detail. The stores they opened in markets where competitors like Big Lots closed, they're doing particularly well, especially if Big Lots hasn't reopened nearby. It just clearly shows they're grabbing that market share directly.
Okay, so winning on real estate.
Yeah.
But stores need customers. Let's talk Ollie's Army. That loyalty program is their kind of their secret weapon, isn't it? It's a powerhouse. 16.1 million members now, up 10.6% year over year. And these aren't just casual members. They shop more often, spend over 40% more per trip than non-members. That adds up to over 80% of total sales.
Yeah, loyalty programs like that, they're not just about discounts. They build stickiness, give you amazing data. And that reimagined Ollie's Days event they ran in June, perfect example. Exclusive night for members, limited deals just for them. Management said it exceeded all expectations.
It really did. Drove customer acquisition up almost 60% just for that week. And they figured it added about 100 basis points to Q2 comp sales. That's a huge impact from one promotion. And the type of customer is changing too, which is interesting. New customers are skewing more mid and even upper income, that classic trade-down effect we hear about. But at the same time, their existing base is trending younger. They think that's down to their digital efforts.
That trade down is such a tailwind for a company like Ollie's, isn't it? It shows that even folks with more money are hunting for value when things get tight. It just expands their whole potential market, almost like a treasure hunt, like you said earlier.
Right. Okay, shifting to the supply side. Management said they're operating with wind in our sails thanks to strong deal flow. This gets us to a key advantage, the consolidation of the closeout market.
Yeah, this is crucial. As the closeout market shrinks, Ollie's becomes the biggest buyer left standing, basically. That scale gives them huge leverage. Better deals mean better merchandise margins for them. Plus, they mentioned lower shrink for the third quarter in a row, so better inventory control helping margins too.
And they flagged inventory being up 20% at the end of Q2. Management actually pointed to that as proof of that strong deal flow. They're grabbing the goods while they can. What about tariffs? How do they handle those? They said they take a price follower approach. If tariffs make something too expensive to sell at their target price gap, they just don't buy it. They'll adjust the mix, find alternatives, maybe domestic closeouts instead of imports.
That flexibility is key. It means they protect their value proposition. They don't get forced into passing on costs that would kill their competitive edge. It really comes back to buying discipline.
Okay, but it wasn't all smooth sailing. Let's talk costs. SG&A selling, general, and admin expenses ticked up a bit as a percentage of sales, 60 basis points higher to 25.8%. They said it was mainly due to an unusually high number of severe medical cases and slightly higher store labor. Is that something to worry about going forward?
Management seemed to frame those medical and casualty claims as transitory, one-off spike this year, expected to normalize. And they actually expect to get some SG&A leverage in the second half of the year, partly because they're comparing against some higher costs last year, things like exec comp and expenses related to chasing those bid lots deals. So they think it'll ease up.
Gotcha. And finally, the balance sheet. They talk about a fortress balance sheet. Sounds strong. $460.3 million in cash and investments and basically no meaningful long-term debt. That's a powerful position to be in.
Oh, absolutely. That kind of balance sheet gives you immense stability, flexibility. You can fund growth opportunistically, grab those real estate deals, expand DCs, maybe even buy back stock without having to borrow money. That's a huge asset in retail today. Agility is key.
So pulling it all together, what's the outlook? Well, Ollie's raised its full-year FY25 guidance pretty significantly across the board. Net sales now expected between $2.631 billion and $2.644 billion. That's a decent bump from before. Comp store sales growth guided higher too, now 3.0% to 3.5%. And adjusted EPS guidance lifted to between $3.76 and $3.84, shows real confidence in profitability.
Yeah, that big guidance raise really tells you how confident management is feeling right now. And remember that new store target is up to about 85 for the year. They're also aiming for a full-year gross margin of 40.3%, operating income between $292 and $298 million. CapEx around $83 to $88 million, which includes building out those former Big Lots stores.
And here's another interesting nugget. They expect Q3 comp sales growth to be above their long-term target of 1-2%. So the momentum looks set to continue. Management even explicitly said they like to guide conservatively, prefer to under-promise and over-deliver. Investors always like hearing that.
Right. And connecting that to the bigger picture, their long-term goal is roughly 10% unit growth a year. They're obviously beating that right now because of these unique opportunities. Looking ahead to fiscal 26, they see double-digit top-line growth translating into mid-teen bottom-line growth. That's helped by having more stores open for longer, less dark rent dragging things down, and hopefully those medical cost trends improving.
So the strategy seems pretty locked in. Disciplined buying, leveraging that closeout market position, and driving traffic with the Ollie's Army. And the macro wins are definitely blowing their way, right? That trade down consumer seeking value is perfect for their model.
Absolutely. And add to that the ongoing consolidation in the closeout world, other retailers struggling. It just creates this rich supply of the discounted goods that are Ollie's lifeblood. Those are powerful tailwinds.
Okay, time for the investment committee segment. Now remember, this is strictly not financial advice, just a kind of wild but maybe plausible trade idea for Ollie's, given that under-promise and over-deliver habit they mentioned, and maybe some conservatism baked into that back half gross margin guidance despite the strong Q2. Well, some folks might look at options.
Right, looking for that potential disconnect where maybe management's caution creates an opportunity if they outperform again.
Exactly. So they're guiding full year gross margin to 40.3%, kind of hinting at a deceleration later in the year. But they keep delivering elevated margin. And the CEO basically said they won't buy stuff if the price isn't right to maintain their gap. That suggests a real determination on margin. So one hypothetical idea might involve setting up a position to capture upside if that margin strength continues, maybe beating those conservative estimates again. If that happens, analysts might have to rethink their 2026 earnings forecasts upwards, right? Especially with lower rents from those big lots conversions and potentially lower medical costs helping out next year. At the same time, you could potentially use that fortress balance sheet strength, the lack of debt, maybe structure something that benefits if the stock just holds its ground or even pulls back slightly, collecting some premium to help pay for the upside bet. It's really a bet on them continuing to execute well against potentially cautious forecasts.
Yeah, the thinking there is basically capture potential upside surprise on margins and earnings for Q4 and into 26, while maybe using the strong balance sheet to cushion the downside or generate income. That wind in our sales comment, the consistent execution, it suggests they're building something solid that maybe the market isn't fully pricing into those forward margin numbers yet. But again, just spitballing ideas here. This is purely informational, definitely not financial advice. Always do your own homework, talk to a pro.
So wrapping up, Ollie's turned in a really impressive second quarter. Strong sales, expanding margins, super aggressive store growth, and that powerful loyalty program firing on all cylinders. They've raised the bar for the full year and seem perfectly positioned to ride these current market waves, the trade downtrend, the closeout consolidation.
Yeah, while they're managing some short-term cost bumps, that long-term growth plan seems very much on track. All the pieces, from real estate to loyalty, seem to be working together and setting them up for more growth ahead.
We really appreciate you tuning in. Let us know what you think. Any feedback for future deep dives? Until next time, here's something to think about. In this economy, maybe the biggest disruption isn't always the newest tech, but simply mastering the age-old art of the bargain.